You heard us kind of laying out some of the back and forth on markets from here. You tend to have a, don't fight the trend dynamic in place when you have Thanksgiving week and then into December. And yet market seems like, in the last, few weeks, it's actually built up a pretty good head of steam, and maybe sentiment and positioning looks like it's getting overexcited. So how do you synthesize all that?
Well, I think what you were saying earlier, you were talking about the market hasn't really done anything in 2 weeks. Yeah. You compare where the S&P closed yesterday to where it closed on September 2nd. Granted, it was a high point on September 2nd, but we're at the same level we were over 2 months ago in the S&P 500. So we've really been consolidating what was a really massive rally off the spring lows. And in the last week or so, we've been consolidating what was a really strong rally in the first half of the month. So it's like, sprinting a 4-minute mile and then just, you're going to be tired. You're going to have to, want to catch your breath and regroup and build up the head of steam. So I think, there are some concerns going into the winter with rising COVID cases, but overall, we're still positive on the market. We think there's more positives than negatives. And this whole idea of what's the upside catalyst going to be to get us to, higher levels come year end. Nobody ever knows what the upside catalyst is. If you had asked someone on October 30th, were we going to have an 11% month in November, no one would have said that. So it's always easy in retrospect to find what the upside catalyst was. But, looking ahead, no one ever knows what the upside catalyst is going to be for a move higher. Yeah.
There's no doubt about that, although I would argue, and the way I maybe look at things is the upside catalyst in late October was people were just too nervous about too many things and probably were underinvested in the theme. So where does that bring us right now?
Well, I'd say people are pretty nervous right now going into the winter about rising COVID cases, potential for more, restrictions on activity. I think there's very big concerns on the part of investors regarding the economy and what it's going to do this winter. But yesterday's market PMI numbers were off the charts strong. They were much stronger than anybody was really expecting. So I think that's a positive that the economy's got more resilience. We just saw an earnings season, which was, fantastic by just about any measure. 30% of companies reporting raised guidance. Normally only 10% of companies even issue guidance. So it's just really strong numbers. And then what we always look to and we default back to is what is the market telling us in terms of the internals, what are the credit markets telling us, and what are the key groups telling us? And if we look at breadth numbers, cumulative AD line is hitting new highs. We're seeing new highs, 52-week highs expanding. The semis, which is a group we focus on intently, hitting new highs. Relative strength of the semis versus the market is hitting new highs. And then as far as the broader stocks, it's not just the big cap techs leading things. It's a broadening out of the rally. But at the same time, the big cap stocks aren't, going down. They're, more like just trading flat. Yeah. So they're underperforming, but it's not like they're really dragging down the index, which would be a bigger worry for people who are invested in ETFs.
Yeah, and this grab for cyclical stocks, smaller stocks, just stuff that moves faster and is more linked to the economic cycle. We saw a version of this in May into June, and then it rolled over and went the other way. What's different now, do you think, about the environment?
Well, so I think two things are different. I mean, now we can look forward and we can see a vaccine 6 months from now where, by the end of the first quarter, that should hopefully be rolled out. So people are looking past that. Second is, what's the characteristics of the stocks performing? So back in June, when we saw the cyclicals and the reopening stocks do well, the COVID stocks, so to speak, they, underperformed a little bit, but it wasn't as bad as they are now. Right now, we're seeing real underperformance on the part of the COVID stocks, and that's telling you, I think, that investors are moving out and broadening their horizons. And when you look at it, you were talking about small cap stocks there just a minute ago. From a valuation basis, the Russell 2000 looks expensive, but if you're investing in the ETF or the index, because almost half the companies in the index don't have earnings. If you just strip out companies with earnings and compare companies with earnings in the S&P 500, what you see is there's about a 20% discount to small cap stocks with earnings than there is to large cap stocks with earnings.
Shepard Smith here. Thanks for watching CNBC on YouTube.